Hey guys, it's Ken from Investing Made Easy here, and today I'll be discussing the crypto market in late 2019, in particular the mining scene. But before we start, be sure to like and subscribe for future videos. Before we start, just a warning that the crypto market is extremely volatile, and anything I say here is just my opinion, and that I would advise you to do your own research before investing into any cryptocurrencies. The reason I have decided to make this video at this time is because the December to January period has always been very decisive for the price of cryptocurrencies. Bitcoin's price exploded over the Christmas 2017 January 2018 period, reaching a price of over $17,000. Furthermore, the next year around, November, December 2018, Bitcoin's price halved from around 6,000 to almost 3,000. Furthermore, the end of 2018 is commonly known as altcoin season. The largest altcoin, Ethereum, had a similar bullish run reminiscent of Bitcoin in 2017. During this period, it reached a peak of just shy of $1,400. This was very important for miners, as majority of residential miners do not mine Bitcoin, but will mine altcoins such as Ethereum. Now, why was mining cryptocurrencies so popular? At its peak, mining was extremely profitable and very easy. Programs such as NiceHash made it as easy as downloading a file, and the program would take care of everything for you. The low barrier of entry and extremely quick returns of an investment led many people to take up cryptocurrency mining. For instance, an AMD Radeon RX 480 8GB, a graphics card with an RRP of only $200, had a return on investment of only about 45 to 55 days. These returns are more than enough to make the whole world extremely excited about purchasing cards such as these. As a general rule of thumb, money printing machines tend to be in pretty high demand. This led to the value of the card to reach around $500 and was sold out almost everywhere. So you may ask, why is it not as popular today? Firstly, mining for cryptocurrencies has become ever more unprofitable, as the altcoin season came to an end rather abruptly. After having hit its peak in mid-January, Ethereum's price did not last long. By the beginning of April, Ethereum had shed over $1,000 per coin. This was a loss of over 73% from its all-time high only 3 months previously. Many of the large altcoins followed suit and shed similar percentages. This cut directly into the profits of miners, as the coin they were mining was now worth significantly less. This would not have been a problem without the fact that mining is not free. Mining cryptocurrencies is an extremely intensive process. Graphics cards consume a significant amount of power. For instance, that same RX 480 consumes around 150 watts of electricity whilst mining, which is about 3.6 kilowatt hours per day. As the profits of these cards decreased, many people began selling them off and turning off their miners. The final nail in the coffin was the rise of ASIC miners, application-specific integrated circuit miners. These are chips which are built specifically for the sole purpose of running a particular algorithm. Although GPUs are pretty efficient at mining when compared to CPUs, they pale in comparison to what an ASIC miner can achieve. ASIC miners are expensive, difficult to obtain, extremely loud, and consume a huge amount of power. Essentially, this spelled the end for residential mining, as large companies began buying warehouses full of these ASIC miners. And as more hashing power was added to the network, the difficulty rose to match. So, what is mining difficulty? By definition, difficulty is a parameter that Bitcoin and other cryptocurrency use to keep the average time between blocks steady as the network hash rate increases. Therefore, as the prominence of ASIC miners rose, so did the difficulty. These large mining warehouses added a huge amount of hashing power to the network, which pushed the difficulty out of range for consumer GPUs. If we take a look at the mining difficulty graph for Bitcoin, we can see that it follows an almost exponential growth pattern. However, we can see that there was a small dip here. If we recall, we can see this is where Bitcoin lost most of its value, from the high of 17,000 down to its price of only around $3,000. This led many miners to turn off their machines during this period, as it was much less profitable with a lower Bitcoin price. Now it's time for the main question. Is mining still profitable? We must first understand that the days of paying off your hardware in a couple of months are over. The profits are much lower today than they were previously. Nevertheless, depending on the price of your electricity, it can still be profitable. Before attempting to purchase a mining rig, you should first crunch the numbers on the power usage versus the amount of cryptocurrency you'll earn from mining to decide whether it's worth your while to build a mining rig. Fortunately, since the most profitable time of 2018, some new graphics cards have been released, such as AMD's Radeon 7. This card will hash at a rate of about 3.5 times that of the RX 480, for an increase in power of only 50%. However, the purchase price of this card is about $600 currently, and it will only mine about $1.13 before taking into account the electricity costs. At a price of 12 cents per kilowatt hour, this card makes less than 70 cents per day. This would give you a return on investment time of around 857 days, a far cry from the 50 days that we used to have. For instance, if you had purchased this card for $700 on release date in February of this year and had mined every single day since then, you would have made about $189 after electricity. That seems brilliant, but you have to remember, in the same period, the price of the new card has dropped $100, and used cards can be found for as little as $550 nowadays, essentially breaking even on the amount that you have made, without taking into account service fees such as eBay. In my personal opinion, I think that you are much better off just purchasing the coins rather than mining them by yourself. The current issue is that there are huge mining farms which have access to hardware with much greater efficiency than what is available to us residential miners. Furthermore, they are able to get bulk discounts on ASIC miners, which allows them to further push their profit margins. Furthermore, the rise in Bitcoin dominance has contributed to the loss of profitability. During the altcoin season, Bitcoin's market dominance was only around 40%. Now it rests at around 65%. But really, the main reason why these large-scale miners are more profitable is because they have access to much cheaper electricity, sometimes 5 or 6 times cheaper than what we have access to at home. Hence why I believe that we should leave them to the mining, and if you want to own or support any cryptocurrencies, you are much better off purchasing it rather than mining it. Thank you very much for taking the time to watch my video. If you've enjoyed it and would like to see more, be sure to like and subscribe for future videos. If you want to find out more about my thoughts on Bitcoin currently, then check my video linked in the top. Until then, thanks for watching. This has been Ken from Investing Made Easy, and I'll see you.